Mike, you heard the litany of hot-seeming numbers in the latest batch. We've gotten, the relatively hawkish Fed speak. Are we in a reacceleration of this economy, or is this just a passing phase?
So I think it's really hard to say because there's a lot of conflicting signals coming out of the economy right now. And some of those conflicting signals were actually mentioned yesterday in the minutes to the FOMC meeting. So I think we'll have a better sense tomorrow. So it'll be easier to answer that question tomorrow than today. But right now it does look like the labor market, the slowing that may be occurring in the labor market is definitely very gradual. But we'll have a better sense tomorrow.
Okay. And then in terms of the way the rates market is repricing Fed expectations and also how long we're going to stay there, it seems as if that's been one of the notable shifts recently.
Yeah, I think the Fed has been pretty successful in disabusing the market of the notion that they're going to be cutting rates, shortly after reaching the terminal rate. So I do think that would be, considered a success here in their communication policy. Of course, they've gotten a nice assist from the data, which has also kind of shaken off the idea that the economy would quickly buckle under the impact of the cumulative rate hikes. But I think July is obviously looking pretty much like a lock unless we get a disaster tomorrow, and then I think the path after that gets a little more interesting given the data we've seen.
Are we searching for that pain point for the economy at this point? I mean, it seems as if growth has held intact. I mean, not at gangbusters levels, but real growth that maybe in the 2% range at this point. Structurally, labor market seems like it doesn't really want to soften up too much in the short term. Again, you have to weigh that against these sort of long lead time forward indicators of recession risk, like the leading economic indicators, like the yield curve. What are we placing most weight on here?
So I think we are kind of feeling our way to that pain point because, I think Chair Powell doesn't trust forecasting a whole lot, economic forecasting. And so I think he's willing to continue to kind of dribble out rate hikes until you actually start to see things buckle rather than just forecasting things to buckle. And I think most notably that has to come in the labor market. And we're really not seeing signs of that. We had a little bit of improvement in lower job openings today, but then you also had a pretty decent increase in quits, which is a sign of confidence in the labor market. So until you start to see those go in the right direction more convincingly, I think Chair Powell is going to be inclined to, continue to dish out the rate hikes until he sees some cracking there.
Mike, ahead of the bank earnings that we're going to be getting here fairly soon here, Lori Logan basically saying she doesn't believe that the banking stress that we'd seen earlier in the year is having an outsized impact on credit availability. Do you agree with that? And how closely is the Fed watching and or worried about that as we could be getting a slew of more information here? Yeah,
I guess it depends on how you define outsized impact. It's certainly nothing like, 2008, of course. But I do think most indicators suggest that bank credit is getting tighter, particularly for smaller businesses. And you see that also in the weekly C&I lending, which has generally been trending lower. So it is a headwind. I don't think it's, an acute headwind, but it is something that, and I think you saw this in the Fed staff forecast yesterday when they were talking about their recession forecast. It was pretty importantly informed by what we're seeing in banking development. So it is going to be something they're going to be watching very carefully because, if they break it, they own it. They're the regulator and supervisor of the banking system. So I think they want to see, tightening being transmitted through the banks. But I don't think they want to get, brought before Congress to answer more questions about more bank failures.
Hey, Mike, on the list of things that people, or at least the bulls, were hoping for, goods deflation, but also now shelter graduating into a period where rents would begin to ease. We are seeing some alternative data suggesting it, but I wonder if you believe it right now.
So in the official BLS measures in the CPI report, you've been seeing some rolling over of those measures of inflation since about March, not in a dramatic way. But I agree with your point that, in some of these alternative measures like Zillow and so forth, you had seen, pretty sharp deceleration late last year. And, I think there was some expectation it would follow through this year. And instead, you really seen kind of more stabilization. So that process may take a little bit longer than people were thinking, 6 months ago. On the other hand, it is, I think it's a positive thing that last week we saw multifamily housing starts at a, I forget, 30-year high or something like that. So you are seeing the appropriate supply response. It just takes at least 2 years or about 2 years for that to get online.
Yeah, a lot of things taking longer than we anticipated in this cycle. We'll see how it plays into tomorrow's numbers. Mike, thanks very much.
Good to see you.
Mike Feroli of JP Morgan.